All right, fellow AMC stockholders, XMAX Trading here. I'm going to go over this Archegos article. Archegos is the hedge fund that blew up. I think it might be related to, might be similar to what Citadel could happen to Citadel with AMC and GME in the future again. So flaws of the market. So let's get started and hit the subscribe channel. All right, guys. Archegos reveals flaws of markets that still need to be tackled. Systemic problems around the use of collateral in trading remain. These systemic problems remain to this day. So pretty interesting. June 28th, 2001. The writer is a former banker and author of A Banquet of Consequences. The teeth gnashing and hand wringing in the aftermath of the problems at Archegos misses a fundamental problem that still needs to be addressed. Misuse of collateral. The hedge funds synthetically purchase Chinese and U.S. shares using derivatives known as total equity swaps. The off-balance sheet transactions do not require payment of full purchase price, but merely the agreement to meet so-called margin calls. These are payments made to a counterparty to help cover potential losses on trading positions. Archegos would have lodged an upfront amount, the initial margin, against the risk of a large market move or non-payment of a margin call. As the initial margin is a fraction of the value of shares, such swaps allow the creation of a large position up to 10 times leverage. In the aftermath of 2008, regulators accelerated the use of collateral to secure bank exposures to shadow banking participants such as hedge funds. However, the system is always flawed. First, the initial margin may be too low. It is based on historical volatility. So historical, but not recent volatility or potential future volatility. Periods of unusual artificial create stability, and trending markets heighten the risk of inadequate margin requirements. Inadequate initial margins. Pressure to increase business volumes results in inadequate concern for safety and excessive leverage. Brokers to hedge funds frequently low collateral levels in a race to the bottom. Second, subsequent or variation margin calls occur after a price move with counterparties being given time to meet the payment. So margin calls occur after a price move with counterparties being given time to meet the payment. Where there are rapid, large moves in one direction, the protection afforded can be quickly overwhelmed. In this case, Viacom, one of the underlying stocks that Archegos had bet on, fell sharply upon the announcement of a $3 billion stock sale and analyst downgrades. Once losses exceed margins, the provider of the derivative has unsecured credit exposure to the counterparty. Third, cash or high quality, usually government securities, were traditionally the major form of collateral accepted. Increasingly, a wider range of securities, including equities, are eligible. The theory is that by reducing the value recognized as surety, known in markets as the haircut, the potential price fluctuations of riskier collateral assets can be accommodated. Unfortunately, this exposes the arrangements to the same model promise as setting initial margins. It also introduces wrong-way correlation where the underlying risk increases at the same time the value of the collateral decreases. Finally, the assets must be realized in case of default. The entire system needs the ability to trade the required amount of both the securities synthetically acquired and the collateral within a short time frame. This assumption is questionable where the swap is used to acquire exposure to illiquid stocks in an environment of diminished liquidity. So this assumption is questionable in illiquid stocks and diminished liquidity. In the case of Archegos, the problem may have been exacerbated by a highly concentrated portfolio in less traded stocks. All the above factors seem to have been present with Archegos. They were in other familiar ingredients: bank greed to generate fees, laxity of risk management, inadequate expertise, deficiencies in risk modeling, and operational issues. As usual, some of the affected banks, eager to protect their own skin, broke ranks in liquidating positions. The resultant disorderly unwinding may further increase the problem. The irony is that overall losses, around $10 billion, maybe at least 50 to 100 times the fees earned from the transactions. None of this is novel. The extreme brevity of financial memory continues to be a factor in such episodes. The problems at Archegos today appear contained, with the affected institutions and their shareholders absorbing the losses. But the systemic problems around the use of collateral remain. Dealings with other hedge funds, trading between banks, and most importantly, clearinghouses for derivatives rely on the same technology. With a high proportion of the 640 trillion total outstanding volume of derivative contracts being cleared and secured by collateral, the risks are non-trivial. But lately, regulators have expressed concern, and some superficial changes might be proposed to rules. It is unlikely that they will address the excessive reliance on the shadow banking system to supply credit or the use of collateral to deal with counterparties who would not normally qualify for trading lines. It will certainly not deal with the fundamental issue that a system built on leverage speculation is inimical to financial stability. Yeah, they over-leveraged themselves. The system is shaky and greedy, and Archegos blew up. I think this could happen to Citadel regarding EMC and GME. That's why they're so terrified. So, very interesting article, guys. Look it up yourselves. Until next time, out.